Now we're going to move on to something very interesting, the operating cash flows. And of course, the timeline, well, this is only going to occur at one point on our timeline here at t equals 0. I hope that's clear. I hope that's clear. So let's move on. Let's go look at our operating cash flows, okay? So before we look at the formula that's written right here, I would like to take some time to really break down the different portions of your operating cash flows, okay? So of course, you're gonna have sales, you're gonna have your costs, and you're gonna have your tax rate. Now this is very much an active recall to what you learned in your intro to finance class, intro to financial accounting class, okay? Because we're just kind of mimicking our income statement here, right? It's a very simplified version of your income statement in which you have, I'll kind of do this, in which you had, remember, revenue, less expenses. And sorry if I'm writing dirty right now, but the idea is that, we're having a conversation. That's going to give you your earnings before income tax. Then you're going to subtract your income tax. And that would give you your actual profit here. In other words, your cash flows. All right. Now, what's awesome is that you could actually simplify this on your exam or when you're studying as simply being equal to sales minus cost, right? That's what we did right here. I hope that's clear. So we have sales less costs, so revenue less expenses. And then we're going to multiply that by 1 minus the tax rate, which is going to give you your profit. It's as easy as that. And that's going to be our operating cash flows. Very straightforward. I guess I said we're not going to begin with the formula, but heck, let's begin with the formula. Now, what I want to make very straight, what I wish would be very straightforward for everybody here is that, of course, we have our sales, we have our costs, and we have our tax rate. Now, sales on an exam, okay, it can be provided as being a constant set of revenues. So every single year, for example, you're going to receive 100K within this project, or it can be growing revenues in which they would say, for example, you're receiving 100K at the end of year 1, but then that number will grow by 5% every single year, such that at year 2, we don't have 100K anymore. You have $105,000, all right? That's very important to remember. So it can be either constant or growing. Now, it's funny because when you go to uni or, CJEF, if you're in Quebec or whatever, we typically hate when teachers use the slides to kind of talk. But in this case, these slides are dope. So I'm gonna use them myself because they really put us in the right position. So it's funny how it's full circle. Now, I want to say one more thing though, because more complex questions, and we're still dealing with sales, they may say they may not give you revenues or kind of like a number to work with. They may actually tell you, you have a number of clients and each client will provide X amount of revenue, okay? So then you're actually gonna have to solve for revenues yourself. So for example, they may say, all right, you have, call it 400K clients and they cost $5 each per client, okay? Such that you would have to do 400K times 5. Now, I guess I could do some basic math. I'm going to say that that's $2 million, all right? And that would be your revenue. So it's important to understand that sometimes they could throw a curveball at you, okay? Now we can move on to the next step, which is cost. Now, cost, typically on exams, they could be given in 2 different manners, okay? They could be given as simply being a percentage of your sales. In other words, a percentage of your revenues. So if your revenues, for example, was $1 million per year on a constant basis, and they tell you that your costs are 20% per year, and this would, 20% of your revenues each year, this would mean that you would have, if it's $1 million, 200K as being your cost, okay? Such that sales minus costs would give you 800K. Hopefully that's clear. So anyways, I'm not gonna go too far with that. And then they could also give you just a constant value. So they say, your costs, it's 100 grand a year. Plug that in. It's as simple as that, okay? However, as we mentioned in the previous bucket for sales, they may also let you know that, no, you know what? You're gonna find the cost per client, okay? You're gonna find that number. And it will be the same little gymnastic that we've done on the previous bucket, at which you're gonna do number of clients times the cost per client. Now, on an exam, cost per client could also be said the cost of acquiring a client. It may not always be in a cute, simple, straightforward fashion. So it's always important to kind of understand that if they don't give you a percentage of sales, if they don't give you a constant value that's easy to plug in, sometimes extra work will be required on your part, okay, to be able to kind of get to this point. Now, another thing that I'd like to mention when it comes to costs, okay, is that costs can be divided into two like categories. It can be divided in variable costs or fixed costs. Now, if you're ever given a question like this, at which you have variable costs, so for example, the cost of acquiring a client, then you have fixed costs, and which on the question they may say, like, I don't know, the cost of your office every single year is 100 grand, okay? So you may have two different costs, variable costs and fixed costs. Variable costs, if I were you, I would always mix them in your sales. So what do I mean by this? So if you know that, for example, you have 400K clients, all right, and you know for those clients, it'll generate revenues of, call it $10 per client, and it'll cost you $5, I guess I'll put it as $4 to acquire a client. I would just say, you know what, I'm going to make this simpler for me. I'm just going to eliminate my variable cost portion, and I'm going to include it in my revenue, such that if it costs you $4 to get a client, but you make $10 per client, technically your net margin for every single client is $6. So you could find your revenues as simply being 6 times 400K. So that would be something that I would do. And this, in this case, would give you $2.4 million as your revenue. And then you would only need to look at your fixed costs. And let's say your fixed cost is, call it 400K. You would have sales minus cost as being equal to $2 million, right? Because you took this amount less this amount. So this is just another little trick that you may not see in your class, right? That they may not talk about, is that sometimes costs can be divided into two buckets, variable costs and fixed costs. If you're given a question at which you're given variable costs and fixed costs, I recommend placing your variable costs straight into your revenues. In other words, subtract that amount if it's a variable amount, right? If it's variable per every client or every output, that every unit of whatever you have, just plug it in there. That's exactly what we did here. We had $10, right, revenue per client, okay? But we also knew that every client costs us $4. Let's make this simpler for us. 10 minus 4, $6 is going to be our sales per client, okay? Multiplied by the number of clients we have, 2.4 million, less our fixed costs. We know that our sales minus cost would be equal to $2 million. It's a different way to go about it. Different students may want to go about it in different ways, but here's a recommendation that I use that makes it simpler for myself, okay? So now that we have that, it's not over yet, okay? Because if the question, all right, notice how I wrote, unless stated otherwise, for looking at the tax rate, your earnings before income taxes are going to be subject to taxes, okay? So you're going to have to multiply your sales less costs by 1 minus the tax rate. In this example, you could have done 2 million times, if the tax rate is 30%, times 1 minus 0.30. And that would give you, essentially, if I could do some quick math, after-tax cash flows of $1.4 million, okay? So you always need to do that. Now, one thing that I'd like you to kind of remember is that some questions, they may just straight up give you your after-tax cash flows. Some questions may just say, yo, you know what? You don't need to do all this gymnastic that I just introduced. We're just going to give you after-tax cash flows, and you could run with that. Because if you're given after-tax cash flows, you don't need to calculate your sales, you don't need to calculate your costs, and you don't need to compute your 1 minus tax rate. All right? This will be your input for OCF. It's as easy as that. If they just give you your after-tax cash flows. So I talked about a lot of stuff within sales, cost, and tax rate. I could know that this is overwhelming, and I definitely hope that you pause the video, because I was kind of freestyling it, and you just write down the pieces that really work for you, okay? But if we just do a quick executive summary of these 3 different subcategories that we looked at, it could look as follows. Now, the most complex form of operating cash flows can be divided into sales, costs, and tax rates. You would be required to compute every single one of them. Now, sales could be either constant, growing, or they may even require you to solve for your sales. At times, students may even want to do the individual like revenue per client less the individual cost per client to find like a adjusted sales value, okay? Now, within the second subcategory of operating cash flows, we have costs. Now, cost could be either a percentage of your sales. It could also be just a simply constant value. What's even more interesting is that your cost can be divided into two buckets, variable cost and fixed cost. If you have variable costs, I highly recommend that you just include it into your sales. Make it easier for you. Just deal with your fixed cost. And your fixed cost will literally be a fixed amount regardless of the number of clients, regardless of the output of the company. Now, just to kind of double down on this notion is that for sure, sometimes you may be required to find the total cost that you may have based on the number of clients, the number of units of production that you may have. Now, finally, within the last subcategory, the tax rate, it's very important to remember that, listen, this is like in our intro to finance, intro to financial accounting class, at which you're going to need to take your earnings before income tax and multiply them by your tax rate. That's going to give you your tax expense. Now you're going to take that amount, that tax expense, and you're going to subtract it to your earnings before income tax. But that seems like a lot of stuff to do. And we could actually simplify it as simply being sales minus cost times 1 minus the tax rate. That's how you earn your operating cash flows. Okay. So our spiel can be kind of boiled down to that little like executive summary. Now, the reason why this is important is because once we find our operating cash flows for every single year, this is where like the magic happens. We can do something crazy with it, is we're going to have to discount them. Okay. We're going to have to discount all these operating cash flows to the present value. So to T0, because two things. They're not occurring today, so they're not equal to themselves. And the reason why they're not equal to themselves is the second thing is because money received tomorrow is not as valuable as money received today. Remember that we're using a NPV approach, so we must discount our future cash flows to the present value. All right. And the reason why this is really dope is because we've done this in the past. We've done this gymnastic of discounting future cash flows to the present value within our time value of money chapter. So this is important because I want you to be able to remember that, well, operating cash flows and all the different categories that we're going to look at that are not occurring today could simply look like all of the different cash flows that we've seen in our time value of money chapter. So I'm talking about our normal annuities, our growing annuities, our annuity dues, our perpetuities, and our growing perpetuities. We could actually arm ourselves with those formulas to solve for these effectively and quickly. And if you're even more sick with it, you could actually plug them in within your financial calculator. You don't need to go through the formula if you don't remember them, or if you don't have it in your cheat sheet, or if you're just not good with it. You could plug all these in one by one into your calculator using the CF function or the PMT/PV function. Really, they all work, and I have a bunch of videos on that. And you'll be able to find the present value of this small category. It's really as awesome and as easy as that. Now you may be asking yourself, well, yo, how do I do that? Our operating cash flows are divided into 3 different topics. Like, this is mad complicated. Well, that's why I recommend that if you are on an exam, I would always recommend that you always just solve for the first year, okay? Solve for the first year of operating cash flows. So for the first year of operating cash flows, I would recommend you to do exactly this. Sales, right? Minus your costs. That's going to give you an amount. It's going to give you your EBIT. And then you could multiply that amount by 1 minus the tax rate. And that's going to give you an output. Okay, that's going to give you an output. I don't know what that output will be, right? This is a hypothetical. But this output, if I were you, if I was on an exam, if I was practicing, and you'll see that I'll do exactly that. And we have our methodology that really like says, yo, do this. But that output, okay, if it's constant, you could just plug it into your formula as PMT, okay? Or you could plug it into your financial calculator as your CO1, right? And then you just put FO1 as the number of years within the project. So this could either be your PMT, or this could simply be your CO1, okay? So this is really, really awesome. Now, this is usually what I would do if we're dealing with a normal annuity, if we're dealing with a annuity due, or if we're dealing with a perpetuity, because then it's just a question of like plugging it in. You found your payment, right? If it's constant. I'll give you another example so it's very, very clear. Sorry, I have allergies, so I may like rub my nose at times. I'm sorry if that's disgusting, my bad. You could just like hide my portion on the left. But let's say your sales is like $100 a year, your costs are $20 a year. such that your EBIT is 80, and then your tax rate, I don't know, let's call it 10%. So it'd be 1 minus 10%. You would have an output of $72. Okay, this would be your after-tax cash flows. Now, if you know that you're making $72 every single year, right, all the way to year 5, right, and this is your PMT, I hope that's clear. You notice how this looks exactly like our chapter 5 time value of money chapter, right? So then you could just plug it in within your formula, or you could plug it in within your calculator and put CO1 as 72, then put your FO1 as being 5, right? I hope that's clear. But what's really interesting here is that sometimes you may have, and also, by the way, if this is a constant output, there's no reason why this won't be the same every single year. That's what I was trying to get to. But what happens here is that sometimes you may be given growing cash flows, right? Or a growing number of clients, or whatever the case may be, such that every single year, well, your sales will increase and your costs may increase, such that you will need to maybe use your actual formula instead, because your calculator may be actually like working against you, because it's hard to just find the value every single year. So my takeaway here is that if you are dealing with normal constant cash flows, it's simple. Just plug your outputs simply into your calculator or into your formula. But if you're dealing with growing cash flows, I highly, 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 highly recommend that you solve for your output, which is our $72 at year 1 type of thing. And then you plug them in within your formula, because it's going to make it much, much, much easier for you to find the present value of this specific category. And now I hope this like rings a few bells for you, because if you were using the table method, which is the first method I talked about in our like first ghetto introduction, you would have to find these values for every single year, and that would be deadly. Or you would have to find the entire value for the first year. This is not like an efficient method. Go one by one, minimize the number of inputs that you need to add to really make this simpler for you. So this is really the best method in my opinion. So of course, the last thing that I'd like to talk about for operating cash flows freestyle is that these cash flows are occurring in the future, okay? And if they're occurring in the future, you're not receiving them today. And because of that, you have an opportunity cost. You need to discount those cash flows to T0, and that's gonna be the present value of your operating cash flows. All right, so that's the first bucket. I'm gonna drink a little bit of water before